There we go. All right. What's up, everybody? It's Kevin Markarian. Hope you're all doing great. I'm here with my longtime advisor and friend, Mr. Peter Zebot, one of the smartest guys I know in the financial space. And we're going to talk today about how real estate agents can benefit from some of the things that he does. So, Peter, why don't you tell us a little bit about yourself, your company, how you got started, and how you can help people in the real estate profession.
So how many people am I talking to?
Anywhere from 30 to 1,000, just depending on how many people are on. And we're going to be playing this over the course of time, and there may be thousands of people who eventually end up seeing this.
Well, I'm a graduate of UCLA. I got an MBA from UCLA in 1969, and I evolved into the business I'm in because my emphasis was in what was then called operations research and statistics, and I had a mathematical training in how to plan for future financial growth from that background. And so my goal has been to learn actuarial science and how do we use mathematics and to plan for retirement and financial well-being. So my background prior to that is my parents are refugees from post-World War II communist Yugoslavia. I came through Ellis Island when I was not yet 3. And we took a train from New Jersey to this godforsaken place called Southern California. And I've been saddled here virtually all my life. In any event, the practical side of planning retirement is to recognize what your options are and how you can utilize those options. For example, I'm on a faculty committee at Long Beach State, Cal State Long Beach, and I often speak to college students about planning for retirement. And one of the tenets I live by is that most college students are living on a shoestring, and the last thing they're thinking is about saving money because they're just trying to get through to meet the week. And what I've told philosophically, I think it's important to understand that if you're going to be fiscally responsible, financially responsible, you need to save money. Now, the key factor here is when you're young, you have all kinds of good reasons to postpone that. I don't have the money. I'm trying to get established. I'm thinking about having a relationship with someone, and the savings isn't high on the list. Mm-hmm. But here's what I tell these about to graduate students. I tell them that your first order is to make a selection in terms of your occupation and find a credible job, so as a stepping stone to better things. Now, whatever that is, the likelihood is when you start out, you're going to have a modest salary and you're going to be struggling financially. But however difficult that struggle is, every individual has the right to set up an IRA account. And under the present rules, someone who's 21 years old could potentially shelter $18,500 of their earnings into a 401k plan if they're employed by a company that offers a plan. But even if the company doesn't offer a plan, you have the option to put in $11,000 a year into an individual IRA. Now, for most people starting out, that's a big number, and they're not going to want to do that. But my advice to them is put in what you can. There's no reason why you can't start out with a $1,000 IRA as soon as you get a job. Mm-hmm. And I will tell you my example. I learned from painful experience. I didn't start saving until I was 38 years old, at which time I owned a company and I set up a retirement plan. And my first the company's first contribution was a mere $15,000. But what happens is when you get into the habit of saving and your business, your financial fortunes improve, it's the same process. You just add a zero to the number.
Mm-hmm.
Maybe your first contribution is 10,000, 1,000. You can go to 10,000. The point is you're saving. You build in the habit of saving rather than postponing your savings until, I was 38 years old when I first started saving, and I had money from a prior retirement plan that I took out and spent. Mm. It was typical of not having a game plan. So that's the starting point. Everybody needs a game plan. Now, the majority of people that I work with own businesses because the leverage of saving comes into play if you're owning your own business. Okay? Now, the question is, what is the earliest, what is the earliest, or at what age is it desirable to become financially responsible?
Any age.
The answer is there's no age too young for you to be financially responsible. And one of the ways to do it is work within your means. Mm-hmm. And rather than saying, well, gee, I can't fund $11,000 into a IRA, put in what you can do and start the process. And it's amazing how things grow when you build a habit of doing things. And by the way, I will use myself as an example. Even though I didn't get started till at age 39, I'm now 72. Our pension plan that we sponsor through our corporation has been funded for 38 consecutive years. And I have over $2 million accumulated in that plan. And I can assure you that during that 38 period, we had some setbacks and investments losses. Mm-hmm. So you don't get discouraged if you have setbacks. You just follow the pattern of saving. Now, that depends entirely on your ability to generate a profit, to develop a career, generate a meaningful salary, and build your equity. But it all ties in with a sense of responsibility. When you treat your job with a sense of responsibility, you tend to be successful and grow and develop. And the logical thing is to plan for success and not plan for failure.
Okay, so a lot of people on this call are in the real estate profession. They're 1099 earners. They have essentially their own companies and they're closing transactions and they're generating commissions. So what would be a good game plan, like you said, for a real estate agent who wants to shelter?
Well, the advantage of being a real estate agent is you're self-employed. Mm-hmm. When you're self-employed, you have leverage beyond an individual IRA, or you have leverage beyond being able to do a 401k salary deferral with your employer who sponsors that type of plan. Now, most people who are on 1099 or 1099 income generally are self-employed and probably have no employees. Mm-hmm. Okay, although there are many people who are self-employed who have employees. But what happens is if you're an independent broker and you are the only employee, you don't have any obligation to fund for other employees. See, in my company, I have 8 employees. And when I fund for myself, I fund for all those employees who meet the eligibility requirements of the plan. And that's part of the budget. Mm-hmm. So the advantage of most of the people we're talking to right now, if they're real estate brokers, is they get 100% of the pie.
But they work for brokers, though. So they may not be, so they are agents and brokers. I just want to make sure we're clear on that. And I think it works for both, but I just want to make sure we're clear. So a person who's a real estate agent works underneath a broker who pays a commission. They get a commission, they get a 1099.
Well,
they still get a 1099.
As far as the IRS is concerned, it's how you report your income.
Okay.
the real estate profession seems to have a very privileged situation. For example, if someone is an IT consultant, in most cases, unless they own their own business, they're going to be, and they do perform services for, let's say, a company or two companies, they can't be paid on 1099. That's just the way the system was set up. The IRS came in and said, you're a W-2 wage employee, you're not an independent contractor. Somehow the real estate profession has avoided that conclusion. The IRS has granted real estate brokers to be independent contractors. So if you're paid on a 1099, it doesn't matter. It really doesn't matter who's boss, who's giving you instructions.
I just want to make that clear.
Yeah, you're independent. So what it means that when someone is paid on a 1099, they generally file a form called a Schedule C, which is self-employed, reporting income and expenses in your own business. And a Schedule C is an attachment to the 1040. And if you are an independent contractor, you can set up a retirement plan and fund dramatically more than the $11,000, depending on your net profit. And that number could be as high as $55,000 for a 401k profit sharing plan, or it could be, depending on the age of the participant, if somebody's over age 45 years old, they can take advantage of a defined benefit plan. And I have, for example, prepared this summary sheet. If someone, I'll show you the sheet. Here's the sheet.
And we'll share it with you guys.
I'm going to give this to you. But the point of this sheet is if you're over age 45 and you adopt a defined benefit plan, instead of being limited to the $55,000, you can fund amounts in excess of $100,000. And we've had instances where clients have funded $500,000 or even $1 million, depending on the age and incomes earned. Now, understand the principle behind a defined benefit plan is it gives people time to catch up for all the years they haven't been funding. So let's say someone is age 55 and they've never had a plan before. Well, I can go to my sheet here and say at age 55, someone can fund $199,813 if they have an income that's at least $150,000 in salary, or let's say $350,000 in net income, maybe $375,000 in net income. They can fund $200,000. Okay, now that's the leverage that comes with so-called defined benefit plans, and that is something that is available to anybody who's approximately age 45. That would be the threshold. And the concept is that we project retirement at age 62, which is the earliest age the IRS will permit. And if you're 55, that gives you 7 years to fund for your retirement, which allows you to put away a lot of money.
Mm-hmm.
Okay, so the question here as a practical reality is, whoever is in business for themselves and if they're self-employed, they don't have the capability, or the IRS will not allow deductions for contributions in excess of the net profit of the business. So, for example, if someone has a Schedule C net of $100,000, then they're going to be limited by that number in terms of how much they can fund, because it doesn't make sense to put money into a plan unless you get a tax deduction for it at the time you fund it.
Mm-hmm.
Okay, so here's what we're talking about. You can start out with something like $1,000 in the individual IRA, and you can work yourself up to $200,000 to $250,000 a year as you get older and as your income goes up. So these are opportunities. Understand that the principle is the same. You fund the money, you get a deduction for the contribution, you get a tax shelter for the money's invested, and you build equity.
Okay, so as a real estate agent listening to this, okay, we're talking about funding. There's a lot of money, obviously lots of numbers thrown out. How do they set it up, and what's the benefit? So if I make $100,000 and I fund $30,000, what's the benefit?
Well, there's different types of plans that you can adopt. So in my role with clients, I'm like a glorified shoe salesman. I'm trying to give them the right fit. Now, I'm starting out on the most practical level. A lot of people may never save throughout their life.
Mm-hmm.
Okay, they're going to be dependent on Social Security. And for those people who are not self-employed, they can't set up a plan. They can only take advantage of what their employer offers. If their employer doesn't offer a plan, then they're limited to what they can do in an individual IRA. Okay, and so if someone's married, they could, depending on their age, they can fund at least $22,000 between husband and wife. And that's certainly something to work with, better than zero.
Mm-hmm.
Okay, now, for all of the people we're talking who are self-employed, you have the advantage of not being limited by the individual IRA limitations. You can adopt other types of plans that give you the opportunity to fund up to $55,000 or even $61,000 a year, depending on your age and your level of income. Now, there is the next step after the individual IRA is something called a SEP. A SEP is short for Simplified Employee Pension Plan, and it is a very cost-effective way to save money because a SEP is funded into an individual retirement account.
Mm-hmm. Like the one I have.
Yeah, but it's sponsored not by the individual, but by the business, the sole proprietorship.
Right.
Therefore, the limitation is not $11,000, it's now $55,000. Okay? Now, the advantage of the SEP is if you're on your own, you have no employees, you can fund up to 20% of your Schedule C net profit, less 1/2 of your self-employment tax. And if your Schedule C net profit exceeds $225,000, then you can fund the $55,000. And if you're over, that's into a SEP. Okay.
Mm-hmm.
Now, the disadvantage of a SEP is that it doesn't offer any salary deferrals, and it requires, if you have another employee, that you give them roughly the same percentage of salary that you fund for yourself. So if you're putting in the maximum, then you're going to have to give that employee 25% of their salary, which can be a prohibitive expense. So the next step up from a SEP is something called a 401k and or profit sharing plan, which is now what the IRS calls a qualified employee retirement plan that cannot be funded into an IRA. It has to be funded into a retirement trust.
Mm-hmm.
Okay. Now, that means if somebody's going to sponsor a 401k profit sharing plan or any other type of qualified employee retirement plan, as governed by Code Section 401 of the IRS Code, you have to have a document. And that document is now, roughly 100 pages. And depending on what type of document you get and what the source of it is, it can cost you $1,500
mm-hmm.
to set up that plan.
Mm-hmm.
Okay. Now, once you have the document, you have to get a separate tax ID number. Your Social Security number doesn't work. The employer tax ID number doesn't work. And then you have to have a separate number for the retirement trust. And then you fund money into that retirement trust. And you then also may have a reporting requirement. If you're self-employed, you're the only participant in the plan. Once you reach equity of at least $250,000 in that account, then you now have a requirement to file an annual return, just like you file a 1040 or a corporation files an 1120, you don't have to file something called a 5500 form. If you're the sole participant and your equity is under 250,000, you get an exemption from filing.
Got it.
Okay. The other requirement is if you maintain a plan like this, is periodically the IRS will say, because of changes in the law, we're going to have to replace your existing document with a new document. And we've done that with you at least once.
Mm-hmm.
That involves another expense. So for most of the people we're talking to, I'm going to assume that most of them are under, well, maybe that's not a fair assumption, but for those who are under age 45, your maximum accumulation is going to be $55,000 a year as a contribution, assuming your net profit is high enough. Okay. Now, if somebody reaches age 45 and their goal is to exceed the 55,000, then there's this wonderful thing called a defined benefit plan. And I use this as an example. I just set up a plan, defined benefit plan, for a woman who happens to be born in 1951, so she's 67 years old. And we were able to fund amounts in excess of $280,000. So if her income is high enough and she's motivated to fund that much, and the business has a profit, in which her case, her net profit is in excess of $500,000, we're able to shelter almost $300,000.
Wow.
So you understand, when you're 67 years old, you're probably not going to be working forever.
Right.
So the defined benefit plan is a leverage vehicle that allows you to catch up for all the years you haven't been funded.
And that's the point with all this, right? I mean, we work so hard as real estate professionals. We're out there. I mean, we need to figure out a way to plan for the future when we don't have as much energy. And I just want to talk a little bit about my sort of structure and what we've been able to do with my plan. I feel like a lot of people will relate to it, because what we did was we basically took the income, we took a percentage of the income, we created a plan. It's basically an account. It's an account at Fidelity. I have a checkbook, and here's the beauty of it. Not only am I offsetting, sheltering money that I would have to pay in tax, I'm also able to buy investments, including real estate property, with the plan. And as long as it's an investment, you can take that money that you would have been paying in tax, put it into an account, and you can buy property. You can buy any kind of investment.
And whatever appreciation you have in that property is tax deferred inside the retirement trust. So let's say you buy a piece of property for $250,000 and you sell it 5 years later for $500,000. The $500,000 goes back in the plan. There's no taxable event because you don't have constructive receipt of the money. It's titled in the name of the trustee of the plan for the benefit of the participant. And then you go out and buy other properties.
And you know what? That's incredibly powerful, right? I mean, think about how powerful that is. You buy a property, you make a huge profit. You don't pay any tax on it. As long as you put the money back in the plan. Stop me if I'm going the wrong way.
That's right.
You put the money back in the plan, and you can keep the money in the plan and continue to invest.
Yeah. The other point is, if you have real estate in your retirement plan, all the expenses, the taxes, the maintenance, whatever upkeep costs are paid by the plan. You don't commingle your personal funds.
Right.
Okay. And the governing principle behind qualified retirement plans and IRAs is whatever accumulation you have is tax deferred until you take constructive receipt of the money. Now, some people choose to do that early, and they may be subject to an excise tax. If they take the money out before they're 59 and a half, they would pay ordinary income tax, state and federal, plus in California, 2.5% excise tax for premature withdrawal and another 10% to the IRS. So the logical thing to do is, if you're going to fund these plans, you postpone your withdrawal until you reach at least age 59 and a half to avoid that excise tax. Now, the beauty of it is, if you don't need to take it out, you can postpone your distribution until you reach age 70 and a half. Mm-hmm. Okay, you understand the IRS doesn't get their pound of flesh until you take constructive receipt of the money and take it out. And they're not going to let you perpetuate it indefinitely. So you reach age 70 and a half. By the way, I'm in that wonderful position of having to take money out every year. And I try to figure out how I can minimize that. That's another strategy that comes into play. But last year I had to take out approximately $75,000 out of a profit sharing plan.
And you had to pay tax on it.
I had to pay tax. I have to report it as income, and it's taxable. But please note, I went from age 38 to age 72 before I took any money out.
And you were making investments throughout the time.
Yeah, absolutely. Now, I think in many respects, it's a good thing that you have to start withdrawing because, for those people who make a high income and are always trying to figure out strategies to mitigate their tax liability, it goes against their grain to take money out voluntarily. So when you're compelled to take it out, at least you start reaping the rewards of all your years of saving.
Right.
So I think it's a good thing. Now, the point of reference here is you still continue to invest the money. The amount of money that you take out when you're in your 70s is probably no more than 4% of the total equity you have if it's a profit sharing plan. And I shifted all of my equity from the defined benefit plan to the profit sharing plan when I turned 71, so I could avoid having to. The ground rules for taking money out of a defined benefit plan are you have to, the so-called required minimum distribution is more than double what it would be in a profit sharing plan. So I took advantage of moving the money over to a profit sharing plan and reducing the amount of money I was required to take out. So, I don't really need to take out $75,000 and it's going to grow each year because my mortality is going up and my equity is going up. But the point that's noteworthy here, if you're required to take out roughly 4% of your account balance, you're still investing that money. And if you're doing a good job of doing that, you're probably earning at least 4% on the average.
Right.
And therefore your principal is never going down.
Right.
And if you keep working, you're still getting more money every year.
Right.
So
wow.
I'm getting at least $55,000 a year that the company's funding in my behalf into a profit sharing plan. I'm taking out 75 and then I'm appreciating.
Love it.
So it's rather remarkable that these plans are still available. There are people in Capitol Hill in Washington that are crazy. They've tried to destroy defined benefit plans going back to the late 80s when the Tax Reform Act came around. And that didn't work. And, the defined benefit plan is proving to be the cat with 9 lives. It's still around. People are still adopting these plans for good reason because it's a great leverage vehicle to reduce taxes and build equity.
Mm-hmm. Well, what I really love about it, and this is how we actually met, was through a man named Henry Glasser, who unfortunately passed away, who was an amazing, amazing guy, who was an attorney. And one thing he said when he talked about this is, it's like taking money from one pocket and putting it into another one, because you can really still use the money as long as you're using it for an investment. And that's just going back to what we talked about there. Like, that money is there. You can still use it. And you're
I think the important thing you're making is that you have control when you take the money out.
You have control.
Yeah. There's no reason why you could start distributions at age 59 and a half if you wanted to.
Let me ask you, what are some examples of investments? Right? So, beyond real estate, what is an investment?
Well, there's a wonderful section of the IRS code called derivative transactions.
Okay.
And if you're the trustee of a retirement plan and you're investing money, you have an obligation to invest it prudently, giving the participants an opportunity for growth, and the whole wide world is open to you. In other words, there are so many investment options that are not derivative transactions. It's very difficult to have an optimal investment strategy because
so many options.
There's so many options. So what we've learned from all the Nobel Prize economists is the key to investment is diversification. And as I've told you, I've had setbacks. One of our investments was a limited partnership in a commercial property that had no debt on it, but I bought it at the wrong time. And as you well know, 2008 was
The wrong time.
The wrong time for the real estate industry, and we lost the whole investment, even though it seemed like a very prudent investment. Okay, so the answer is there's risk involved. It's hard to evaluate risk-reward relationships, and it's hard to define any science of investments. But what it comes down to is you use principles. You say, either I'm going to make the investment decisions myself or I'm going to hire a professional to do it. In my case, I choose to hire professionals. You might feel differently because you're comfortable making your own decisions. That's fine. Now, the only thing I caution people who decide I'm going to be my own investment manager is you have a fiduciary responsibility to fire your investment manager if he doesn't do his job well.
Maybe you can't fire yourself.
Yeah. Anyway, the point is, these decisions become more and more important as your account grows.
Right.
I mean, the difference between a 4% return and an 8% return on a $2 million account is a lot of money on the table.
Yeah.
Now, most of the people we're talking to probably are just starting out, so it gives them time to go through the learning process of how to develop an investment strategy. I tell my clients, listen, you can do everything perfectly. You can make huge profits every year, fund the maximum amount you fund each year, and I can do my job the way I'm supposed to do it, where we don't have any sanctions or penalties for failing to do something. But if you have a poor investment plan, that will undermine everything.
Yeah.
So that's something to be taken seriously.
Well, speaking of that, and we're almost out of time. I mean, you've helped me so much. You've helped me tremendously throughout my time doing these investments.
Well, it's going to get better when you reach 45 because you're going to be able to fund more money.
Right, and it's kind of it's an interesting place to be, right? To reach 45, am I looking forward to it? Should I maybe not?
It puts the burden on you to make a larger profit.
There you go. So I'm working on that, but you've certainly helped me quite a bit. So, now we're kind of running short on time. So if someone wanted to get a hold of you, how do they do that? What do we do? I mean,
now, let me understand. The audience we're talking to are not exclusively your associates. It could be anyone.
Anyone.
Well, essentially, the role that I play is what's called third-party contract administrator. When somebody establishes a retirement plan and create a document, adopt the plan, set up the trust account, start funding the money, and then subjecting yourself to having to do annual reports and having to calculate what your minimum and maximum contributions are. That's generally, you hire someone that's a third-party administrator to help you go through all that, okay? Now, I own a company. The name of my company is PMZ Pension Corporation. We're now in our 38th year as a company. I think of all the highly conspicuous, renowned companies that were in existence, financial institutions were in existence in 1981 when I started PMZ, and realized that my modest-sized company has rolled along making a profit every year. It's astounding to think of how many others have gone out of business. That were around 100 years. Like Kidder Peabody's a classic example. Yeah. They opened their doors in 1869, and they got absorbed by Paine-Webber, and Paine-Webber has now been absorbed by somebody else, yeah. and you have fewer institutional players. So I find that intriguing.
It's amazing. Congratulations.
It's a dynamic, just like the real estate business is a dynamic business.
Yep.
So is the financial wealth management business. And the point is, I think I've been successful doing this because, number one, it's something I love to do. I'm always intrigued by meeting individuals like Kevin and so many other people. Last night I had dinner with a married couple who are both dentists who happen to live in the Seattle area. And we've been doing their work for 20 years and going through all kinds of challenging endeavors. And they recently purchased a commercial property inside their pension plan.
Great.
So anyway, the answer is the formal name of my business is Pension Maximizers, PMZ Pension Corporation. And we have an office in Orange County, South Orange County, in a town called Aliso Viejo. And if I'm allowed to do so, my phone number is 949-360-8080, 360-8080. And if you want to call me off hours, my cell number is 949-285-9774. I'm happy to confer with anyone, whatever their stage in life, because the principle is if you're 21, the sooner you start saving, the better. I had a client who's now deceased, unfortunately, was a very successful investment manager, and he had employees. He said, the goal is to get to 100,000 in your retirement account by the time you're 30. That is one index of success. So for all those people out there who are young, who think their income is so modest they can't afford to save, understand the first 100,000 is the hardest to accumulate.
Yeah.
As you learned, right?
Yep. Yeah.
So, anyway, how should we close this?
Well, we'll include all your information as the phone's ringing. He's obviously a very busy man. We'll include Peter's information in the comment section. And if you have any questions, feel free to post them, and we'll definitely make sure Peter gets back to you. So thank you very much,
Peter.
everyone. He's already on the call. He's a busy man. He's awesome. Thanks, guys. Take care.
Okay.